Welcome back, everyone. As we're a bit pushed for time, we'll move on to session 11 on index-based insurance. But if there are any questions for Kofi following Kofi's session, we'll make time at the end for questions as well before the coffee break, and also during the coffee break as well, in case they come up. Otherwise, over to you, Andrea.
Thank you, Pascal. Well, good morning, everyone. Today's session, or today's sessions, Coffee and my session, I really focus on technology. And I think that this topic that we chose for today, index-based insurance, is not new for anyone in this room, or virtual room. I actually am very happy to have countries who have engaged with index insurance for a long time. So this session of today is more like an exchange of experiences rather than a presentation, and we're not going to do an activity. We originally thought about doing it, but I think that we really will take a lot of advantage of sharing or learning from other countries. So I would start first maybe by setting the grounds of the conversation of today. So what is index insurance? Why is it so important? Why is relevant when we're talking about technology, innovations, and so on? Then we will have the pleasure to hear a little bit from our friends from Kenya, who are going to share some thoughts around index insurance, the risks that are associated with these type of products and how they have addressed those. Likewise for our friends from Zimbabwe and our friends from Ghana, who recently have addressed as well this topic in the new insurance law. Then I will wrap up with some final remarks, considering some guidance that is already available and that has been provided by International Association of Insurance Supervisors and also by the A2II. And yeah, we're going to close with those reflections. Now, maybe let me just start with why is this relevant and why we have seen all these index insurance schemes being developing in the last decade or so. So I'm just going to reiterate on some points that Kofi mentioned during his presentation on climate risks yesterday. One key point is we see that effectively weather events that have huge impacts, in particular on low income populations, are becoming more severe, more frequent because of climate change. I included here some information for you to reflect on. For instance, weather events, the frequency of weather events has increased sixfold since 1950. Maybe something very important in terms of who is generally more targeted with these events is 5,400 million people have escaped from poverty before, thanks to all the efforts that have been taken in the last 20, 30 years. But climate change, precisely with these impacts, is pushing back again to poverty to some populations. So this is why we say that climate change may force 100 million people into extreme poverty. So we will see this kind of situation that it's becoming quite complex for everyone. Globally, this will have a huge impact because we will see that the economic impact of these events is shrinking the global GDP. It is expected by 2100 that the GDP might be shrunk by 7.11% because of these events. Now, with this landscape, we would imagine that insurance could play an important role. But very importantly, it won't be the only solution. Insurance is not the silver bullet who will address all these topics, but it is a very useful tool as part of a disaster risk management strategy that is comprehensive and holistic. The problem is that, unfortunately, insurance hasn't really got the grip on these situations. Very recently, Swiss Re published a report that updated those figures in terms of the insurance protection gap. And in this report, it was said that the insurance protection gap for health, mortality, and natural catastrophe risk, which are like the focus of our conversation today, reached to a new high of $1.44 trillion in 2020. So we have this huge problem that insurance could actually be useful in this context, but is not really playing a role here. So with this context, index insurance comes as a relevant tool to be used. Why? Because let me just see, because I cannot move my slide. Oh no, yeah, now I can. Sorry. So index insurance is more like a modality of provision of insurance. Is not a specific only for climate events, but is becoming very relevant, and it has been becoming very relevant for these particular risks. We're going to see how actually index insurance as a modality could be used to cover other risks. But let's focus on its role in managing climate risks. So let's get back to the definitions. And I know that you are all experts on these. A lot of in your countries you have been testing these, but let's make sure that we are speaking the same language here today. So and you share already some interesting insights in the forum about what is index insurance compared to indemnity products. So the objective of index insurance product design is to develop an index that effectively captures the relationship between the indexed variable and the potential loss. So we have insurance contracts that make payments based on the occurrence and intensity of an event as measured by an index. It's not necessarily by like going to the field and assessing the loss. So that is one important element that I think that we all agree and are aware of. Then we have the amount. Sorry, I'm having like some issues with this slide because of the animation. My fault. The amount paid is calculated in a pre-agreed model caused by these events. So this modeling, as you can see, is key in order to determine not only the index where we are assuming that this loss is happening, but also the amount paid is calculated in a pre-agreed way to be linked with this kind of potential loss. Then the payout is determined by the size of the event. It could be wind speed, rainfall, etc., or the performance of an index. So as I said, the index could vary. It could be, for instance, the hotel occupancy rates, the number of people who contracted a disease, a factor that actually became quite relevant during COVID, and we're going to give you an example on that. A well-designed index trigger is structured in a way that the payout correlates to the loss suffered. So I highlight again, the modeling process becomes extremely important, and in order to carry out like a very strong modeling process, access to weather information, access to yields of farmers, access to all this information that will really help the experts like reinsurance companies or specific modelers that are participating in this process will be able to define how to correlate these losses that are expected to be suffered with this index, and the payout will correlate with these losses that are expected. It offers a set of advantages, and I think that this is why we are seeing these products becoming more and more predominant, mostly when we are aiming to focus on unserved and underserved populations. One important point, and I think that it's very clear for all of us, is that they bring lower transaction costs. First, because there is no need to go to the field and do a physical assessment of the loss. That loss is determined by the occurrence of an index. So once the index happens, once the trigger is there will be a payout. So that makes the transaction cost quite low. And then it's very transparent as well in a certain way, because there is this index that has been pre-established, pre-agreed, and there has been like an insured amount that has been pre-agreed that is correlated with that index. And the payout will be done based on that, on those conditions. So it will be quite transparent, because once you see the trigger, you expect this payout and you will end up receiving it quite quickly. That kind of like a speedy process is also supported by the fact that effectively there is no need for a loss assessment that is going to be done in the field. So those are like elements that I wanted to bring here today, because they are like really the basics of index insurance. Seeing your responses in the forum, I know that you understand very well the concept of index insurance. And maybe something else that it's very important for supervisory authorities when we are confronted with this type of innovations is that there is an important risk that is associated with index insurance. This is basis risk. And basis risk is actually the flawed correlation between the loss to the insured and the amount calculated by the index. This basis risk could be positive or negative, in the sense that in some cases beneficiaries might end up receiving a compensation even though they haven't suffered losses in reality, or it could be negative in the way that beneficiaries do not receive a payout even though they have like suffered losses in the field. So what's the problem here? There is a bad design, most probably, of the trigger, and that creates certainly a lot of concerns and supervisory risks, as we are going to see later. So maybe just to give an example, so we have here a nice example of a simple rain deficit index insurance structure. So you could see that the maximum payout here is 250 euros. So it's here on the top. And that means that basically whatever happens, the maximum trigger won't go beyond that amount. So that's the maximum insured amount that will be paid. The payouts will be provided all along this line. So you see that the rainfall, the millimeters of water are like in the line below. So you see that in 600 millimeters, there is a trigger. Why? Because it has been modeled in a way, and it has been supported on data and information available through national and international mechanisms or sources. That 600 millimeters is the minimum requirement that the crop that we are focusing in this moment needs. So once the water changes and is lower than that, there is the presumption that the crop will suffer. So anything that goes beyond 600 up to the exit point, that here is 300, will imply that there is a loss, and then therefore there will be a trigger. And you can see that in this example, we have an index insurance product that provides payouts depending on the level of severity of the drought. So for 600, the farmer won't receive anything, but after that, for instance, if the farmer suffers a deficit of rainfall in his or her area of 500, they will receive 75 euros. And the maximum will be 250 euros when the deficit reaches to 300 millimeters of water. So it's it looks simple in the sense that is more transparent and like relying on the subjectivity of like an adjuster going to the field and saying, okay, this happens. Here it's very transparent and obvious. The problem here is to make sure that all these information and modeling processes that was behind the structure of this idea makes a lot of sense and is based on the right information and the right modeling processes. So that's maybe something to highlight for today as well. Now, There are different indexes for different perils. So I just gave an example based on a product that provides a rainfall deficit coverage, like in drought. But there are products that cover nowadays flood. There are products that cover wind speed, for instance, in the case of cyclones, hurricanes, depending on the region we're talking about. So it's really evolving very quickly, and nowadays we're seeing more and more products that could be developed in a modality of index insurance. I think that that precisely shows how flooding, for instance, has evolved over time. Before, it was a product that was very difficult to model, that it was very complex to implement, but nowadays we're seeing more and more products on that. So just highlighting that there is a lot of diversity in that respect. Now, as I mentioned before, these products are like increasing exponentially in terms of the use, and actually sub-Saharan Africa has been a region where gave us a lot of the main examples on this topic, and these examples have been replicated and have been like the supporting, the stepping stone for other index insurance products in other parts of the world. So I have to say that you are really pioneers on this. And we have seen that these products have been increasing in the last 20 years. I want to highlight that this is new, but it's increasing more and more. And the reason why this is increasing more and more is also because technology is more available, and this technology is supporting two processes that are key for index insurance. One important process is like the design, the modeling. So there is more data. There are more ways of like making sure that there's a correlation, a closer correlation between the index and the expected loss. For instance, they have been using a lot of processes in terms of improving weather information of local, of national and regional agencies. There are institutions that are really focused on building that local capacities. But then on the second side, there is a lot of implementation, a lot of this innovation. Hello, if you could like mute yourselves, please. Thank you. So here is very important to say that for implementation, there is a lot of innovation as well. Kofi mentioned, for instance, some examples in livestock insurance. Here in index insurance, we have drones. We have like a lot of use of crowdsourcing data, where people actually use mobile phones to take pictures and send information about like how the crops are going. And all this information actually is crowdsourced by insurers and reinsurance companies in order to improve all the implementation process. So we see that effectively technology plays a key role in the design, but also in the implementation of index insurance. So this is why we're seeing as well this increase of use. If you look at this, there are regions that actually have a strong focus on index insurance products. You see, for instance, in Africa, compared to Latin America, where still indemnity is widely used. In Africa, there are more and more products that are index based, and that's very important for this training. No, maybe something else here. Why is this so encouraged when we're talking about inclusive insurance? Why are we talking about index insurance? We're talking about inclusive insurance. As I mentioned, all these elements that reduce the administrative cost and ensure transparency and efficiency are very important for smallholder farmers and low-income households, small and micro entrepreneurs, because they need affordable products, and also they need products that provide payouts very quickly. It is very complex if there is a huge tsunami or a huge earthquake, that loss assessors will be able to go to the field. So and that will really delay the process of receiving the claim. So it's very important to really use these tools as well to give the promise very quickly, to provide payouts very quickly, and honor these element of the compensation. And this is very positive for the reputation. However, index insurance is not the panacea, and I think that we're going to really focus on this today. There are a lot of pitfalls with index insurance, with its implementation, that actually could go against these positive expectations. It could be related in terms of like how speedy is the process, but it could be related as well in terms of like how maybe in some cases the index is not well designed, and that can create a reputational issue, not only at the micro level, but also at different levels. Having said that, let me just go back to something that I mentioned before. So index insurance is just a modality of insurance. And even though we're seeing it more widely used in agriculture insurance, in climate risk insurance, actually this modality is currently being used way beyond. And I'm going to give just an example for the benefit of the time. And this example relates with diseases. So actually, before COVID, there was a pandemic bond that was designed by the World Bank, and this pandemic bond had different conditions to be triggered. One of the conditions was the number of people who died because of this pandemic. And precisely last year in April, I'm just looking at the number, I just want to make sure that, 17 April, this pandemic bond triggered precisely because of COVID. And this bond paid $195 million to 64 countries because of COVID. So you see that here the index is not based not only on weather, so it's a modality that is being used widely. I want to highlight maybe something important. COVID-19 pushed all of us to continue with the provision of insurance, even though despite the social restrictions that were imposed in some of the countries. This implied that loss adjusters couldn't go to the field and verify if losses happened. So this led to an interesting practice that is becoming quite beneficial for index insurance. So some insurers decided to establish other ways of verifying the losses, and that led to the development of more index insurance products. So we're expecting really to see more and more of those products. And I just included here an example of a business interruption product that has been designed in Israel that protects SMEs. And here, let's say the index that is set up is more like the declaration of a customer's critical IT service that has been presented. So you see that it really depends, and we're going to see more and more of these products, even way beyond climate risk insurance. Now, I think that this is quite all familiar for you as well. So index insurance is a modality that has been used in the context of climate risk insurance, not only at the micro level. So when I say micro level, I'm talking about insurance products that are being designed and are purchased by the smallholder farmers, but small and micro entrepreneurs, the households directly. And we have examples in Africa. I actually picked some of the countries who are attending this training. So there are two examples that I wanted to highlight. So Pula, for instance, Pula Advisors is a technical service provider that is using a lot of the elements that Kofi mentioned in terms of technology, precisely with the objective of designing better and better index insurance products. They focus in area yield index insurance. However, they have as well weather index insurance products. Maybe the difference, just very quickly, area yield index insurance are products that are supported on the reduction of yield of the farmer, and the index is based on that. And Pula, what they do is actually they carry out crop cuts, and they define what is the trigger, the index, where crops could go below. Well, if they go below, if the yields go below the trigger that has been set up after having done some crop cuts very randomly, then that the trigger is established, and if that trigger is present, then there will be a payout. But Pula goes beyond that. They have like developed a lot of digital processes that are facilitated by mobile phones. They also provide information, and they are present nowadays in different countries in Africa. They are delivering services to 5 million farmers, and I think that our colleagues here of Zambia, Kenya, Uganda, Ghana, and Ethiopia are quite familiar with them. Also, another program that I wanted to highlight, and you might know, is the R4 program of the World Food Program. This program is really reliant on index insurance as well. Currently, around 180,000 farmers around the world are being covered, and some countries in Africa that are part of R4 are Ethiopia, Malawi, Zimbabwe, and Zambia. So these are the products that we kind of see and we are more aware of. But there are other index insurance products that are offered to other, let's say, levels beyond the macro level. So there are meso level products that are actually targeted to those entities who offer services to the smallholder farmers, the households, and small and micro entrepreneurs. So we're talking about products that generally provide coverage to financial institutions, also to non-governmental institutions. So once there is a trigger, they receive a payout, and that payout will help them to continue providing their services. So I will give an example that probably you have as well in your countries, which is ARC Replica. So ARC Replica actually is a mirror of ARC that we're going to talk about. ARC is a product that actually is offered. It's a risk pool sovereign level modality where governments actually have access to an index insurance product provided by ARC. And this product has been mirrored and has been like purchased by some non-governmental entities in some countries in order to make sure that they will receive payouts as well based on the triggers established for ARC, and they will receive funds that will help them to support the government in addressing the event that is being covered. So generally in ARC, we're talking about drought, but there are other events that are being developed currently. So that's one example. Another example is not necessarily about insurance. This is more like a derivative model that has been created by Global Parametrics and Vision Fund. Maybe you are aware of that because in your countries this is being offered as well. And these actually focus on giving some support to financial institutions so they can keep providing loans in competitive conditions despite the occurrence of these events. So this really provides the contingency liquidity that these financial institutions need in order to keep providing their services, which are key during this time as well. So that is at the meso level. Now let me just get to the macro level again. So macro level solutions are really targeted to governments. So that's the example of ARC. I think that you're going to talk a little bit more about that. And some countries who are part of this training are members of ARC. A similar approach is being developed in the Caribbean and now in 4 countries of Central America through the CRIF. In Asia, there is a risk pooling mechanism as well, which is CDRIF. And in the Pacific, there is another one that is PICRIC. And there is another one that is being discussed and created, and we hope to see it in a couple of years. So let's focus on ARC, because I think that this is quite relevant for all of us. So this pool has been in place since 2014. And what I want to highlight is that over all this time has paid over 58 million to the countries that are part of ARC. And you can see it in the slide, which countries are part of it. And maybe now having Malawi part of this training, I might want to take the opportunity to give the floor to Edwin to share some thoughts about ARC, because Malawi is one of the countries that have been members of ARC already for a while, and you have had some shortcomings during the drought of 2015-2016. So Edwin, if you don't mind, would you like to present a little bit your thoughts about what is ARC, why is relevant for your country? What was that issue that I was mentioning about with the droughts in 2015, 2016? What are your current expectations with ARC as a supervisory authority? And very importantly, what is the role of the supervisory authority in all of this discussion of ARC as a disaster risk management tool?
Okay, thank you, Andrea. I'll just quickly go through what you have asked me here.
Thank you.
Yes. So as you have indicated, looking at the countries that are being covered under ARC, we share similar problems when it comes to climate change. And one of the major problems that is related to climate change is drought. So the relevance of ARC to Malawi has been how to manage food security and also to alleviate vulnerabilities to the majority of Malawians who are smallholder farmers. So on average in Africa, 80% of the population are smallholder farmers, and that is the same landscape as in Malawi. So from 2014, Malawi really joined ARC. The idea is to ensure that ARC provides rapid and quick access to financing during disaster. It's not like to have everything that will cover whatever has been lost in disaster, but just to make sure that as you are putting on a more comprehensive disaster response, ARC comes in to make sure that we manage the immediate needs of those affected by the disaster. And indeed, in 2014, Malawi paid the premium and was part of ARC. I should just mention that ARC is an agency of the African Union, so it's a Pan-African initiative owned by Africans. So what happened in 2015 and 2016, while other areas of Malawi reported the heavy rains, most parts faced drought. So for a normal human being like me, I know that here in Malawi there is a drought, and Malawi purchased this ARC. And the expectations is ARC is supposed to pay, is supposed to make some payout to cover the losses as a result of drought, but that payout never came. So then there was the issue that here we are, we paid for ARC cover, and now we have this drought that everybody in Malawi knows that this part of the region, people have been affected by the drought and their food security is at risk. So ARC should come in. Then ARC didn't come in. Why? The reason was because of the Africa risk model that they use and how it was parameterized. It's an indexed, it's a parametric drought insurance policy, index-based insurance, that was said that it will only make a payout if a particular number of farmers have been affected by the drought and they are growing this specific crop. So the ARC in Malawi just targets the corn fields, the maize fields farmers. So what happened later on is the government then undertook a survey just to assess the impact of the drought, and for the government it noted that no, ARC was supposed to pay, while ARC said using its model it was not supposed to pay because the threshold has not been triggered and the number of farmers affected has not been reached. Anyway, then ARC at least went a step further to make a comprehensive study or research into what exactly happened, and they did realize that during that season most of the farmers had changed farming pattern. They had gone to plant maize that had a shorter growing period, which was not assumed in the model. The model for example, the model said no, farmers will grow crops that mature in 120 days, but most of farmers that year opted for crops that mature in in 90 days. So because of that, the drought affected more those with the shorter growing period during that period. So it was against the parameters that were set in the model. Then ARC was supportive. What it did, it recalibrated this model with the new information and eventually paid out 8.1 million US dollars, if I remember correctly, to the government of Malawi to assist in the covering of the drought. So quickly, what happened afterwards is the government realized that in order to have a more comprehensive cover, then we should bring in more stakeholders on the table, so that when we are customizing the parameters in the ARC model, which is called the Africa Risk View model, we should make sure we are not missing out. So as I'm speaking now, there's the customization taking work group where the regulator participates. The regulator participates as an insurance expert, and also to make sure that the program that is being covered in ARC speaks to what is being provided by other providers in the country, because the regulator has that access to information. So the working group now has Ministry of Finance, Ministry of Agriculture, the Statistical Office, the Climate Change Department, the civil societies for farmers, those who are in microinsurance, the Department of Disaster Management, including even the industry, the insurance industry. So that is on ARC. So I just want to quickly say, in addition to ARC, the role of supervisor has been now to also to help develop new products that are weather index in nature. So as you are aware, in 2005 to 2010, the World Bank undertook a project that was targeting farmers for weather index, and a lot of farmers participated in that project. So when the World Bank project ended, the industry association came in and said, we'll continue with the product, all the insurers in the country will share the risk. So it's like a policy at the industry association level, but all the general insurance share the risk. And the role of the regulator there is the usual prudential and market conduct requirements that are involved, as well as the product approval if there are any changes. In addition to that, you have lightly mentioned about PULA. I could see that there was no Malawi, but I'm happy to point it out that starting from next year, PULA again is coming to Malawi, because the government of Malawi has included specifically in managing disasters in Malawi the use of insurance in transferring disaster risks. And PULA has come in with expertise to how to come up with that product, and the regulator has also been invited on the table. Discussions are just beginning, but we are targeting 110,000 households with a sum assurance cover of about $7 million. So thank you.
Thank you very much, Edwin. That's very helpful. And I think that it gives us already a hint of like the elements that might be a concern for supervisory authorities in terms of index insurance, but not only to supervisors, to governments. I mean, like the situation that happened in Malawi in 2015, 2016 could have led the government to lose completely hope to insurance. It was a reputational issue for index insurance. But what's very interesting is like the parties got together. Index insurance is not perfect, and they remodeled the situation. The African Risk Capacity provided a payout, but also remodeled the product in a way that will be tailored to the particularities of Malawi. And now they are working again together in order to continue with this engagement. Also, something very important that you highlighted, Edwin, is the fact that this element of like a sovereign level protection is part of a wider disaster risk financing strategy that Malawi has. So this is not the only thing that is going to solve a problem. So it's part of the puzzle, and this is very important as well for supervisors to consider, because then plugging in micro solutions, meso solutions will be very helpful. And I think that this partnership that ARC and PULA have precisely look at finding synergies to bring down as well the benefits of like macro level solutions at the micro level. So thank you very much, Edwin. I don't know if there are some questions from anyone to Edwin. Otherwise, please feel free to share them by the chat, and we can discuss it later. But thank you very much, Edwin. I think that some of the members of ARC who are participating in this training. Really appreciate your thoughts. Now, let me get back to this. So I think that based on this presentation,
there is a hand from Robson.
Yeah, please go ahead, Robson.
Thank you very much, Chandra, and thank you very much, Andrew, for sharing your Malawian experience. Just to check, how did you manage to convince ARC to recalibrate the model at the claim stage? Because my understanding is, in terms of pricing, is a function of what you are expecting. Then to recalibrate the model at claim stage and then pay basing on the new calibrated model. Was it a sort of an ex gratia payment to manage reputational risk? How did you manage to go about it?
Oh, thank you. I would agree with you more with the issue of reputation. So because ARC was just beginning, and then to start on that note whereby this is what a customer expects to be paid, but it's not being paid, it was a huge reputational risk on the ARC part. And then as Andrea has mentioned, it was also an issue of hope on the Malawi government that what's the future of ARC then if you are not benefiting. So I think, and the third point was to do with is something that we learn along the way. So ARC, I think, also realized that looking at the resources that we worked on initially, I think there was room to recalibrate the model and to make payments so as to manage the reputation, to give hope to the new customers, and at the same time as a learning process for the ARC. Thank you.
Thank you, Robson, for the question. Thank you, Edwin, for answering. Great. And please feel free to keep sharing questions through the chat or raise your hand. Today is more like a discussion. Okay, so now I want to just to bring a little bit the lens of regulation and supervision. What is the role here? I think that Edwin already showed that the role of the regulator will go well beyond regulation and supervision here, because it could be really a key stakeholder that can like engage with all the parties and be the insurance expert, the insurance champion in this discussion. So that's very important. So let me just get back to go a little bit deeper on this, and let's think about the obstacles that some of the practitioners have identified on climate insurance, on climate risk insurance. And actually regulation and supervision have been mentioned as an important obstacle to keep innovating in index insurance and more broadly in climate risk insurance. In 2019, with the A2II, we had the opportunity to carry out a survey with around 60 stakeholders participating in all these models around the globe, and they highlighted that actually the not allowance of index insurance was one key factor for them to mobilize effort to innovate. If you see this particular table, and we're going to share with you this study so you can have a look at it, they highlighted that effectively index insurance is complex. It's not perfect. It's in a improvement stage as well, and sometimes the fact that regulations are quite stringent and supervisory approaches are not really open to innovation hinder them to really move forward with that. So this really shows us that this is a nice example of implementing the proportionality principle here, because we have an innovation that could have an interesting potential if managed well. And that means that more people could be covered. People might have like a good experience if it's managed well. So these really bring us to striking the right balance in allowing this innovation in certain conditions, and by ensuring that consumers are protected and the stability of the market is safeguarded. So with that, I want to bring some interesting examples, because in this training, we have really leaders and pioneers on index insurance and supervisory and regulatory approaches on that. So before getting into that, I wanted to ask you to, during this session, to please answer through the chat, everyone, all of you, these two questions. Are index insurance products offered in your country? So please put yes or no and include in brackets your country. And share with us what are the main concerns that you have regarding these products. So please do so while our colleagues will present some of their experiences with index insurance. So we have today our friends from Kenya who are going to share some interesting thoughts around this topic. I think that also our colleagues from Zimbabwe and from Ghana, who recently engaged into regulatory adaptation in order to recognize index insurance. So if you're okay, I will start with Kenya. So I don't know, Mary, or who would like to take the lead on presenting your case?
Hello.
Hello. Yeah.
Okay, fine. I'll present.
Excellent. So I will stop presenting. You share your screen, your slides.
Okay, just a moment.
Thank you.
Okay, good afternoon. Maybe on behalf of my colleagues from Kenya, I'll just try to make a presentation of a case of a yield index. And before that, I would just like to state that in Kenya, there are several index insurance products. And as a 2020, we had the multi-peril crop insurance, which is a traditional indemnity insurance. We have the weather index, which is a crop-based insurance, which pays out in the event of the various perils caused by the weather, that's the drought and the floods. Then we have the index-based livestock, which is based on the forage to sustain the livestock. Then there is insurance cover for individual livestock, which are purchased by those farmers who have commercial, who engage in commercial dairy and such. And then we have the area yield index, which is what I'm going to focus on. So the scheme was launched in 2018, and there are several stakeholders who are involved where the government subsidizes. We have the banks and microfinance institutions who offer loans to the farmers. And so as part of when they give out, they advance the loans, then insurance becomes part of the loan. We have the non-governmental organizations who work very closely with the farmers. We have the agricultural input companies. These are the ones who sell products to the farmers. From the insurance side, we have the reinsurers, we have the insurers. Then we have the commercial farmers, those large-scale farmers, who at times they come and form some organizations or associations. So the organizations are also involved. Then we have the small-scale or subsistence farmers. So the insurance cover pays out in the event of the expected yield falls below. And the perils that are covered are drought, floods, pests, and diseases. And this covers crops only. It doesn't cover for the livestock. The area yield covers only the crops, not the livestock. So the target are mostly the commercial farmers and the subsistence farmers. But because at times it becomes a challenge to access directly, and especially most of the subsistence farmers, I'll discuss the challenges later on. So that's why the promoters, they have to work with other partners, the banks and the microfinance institutions who extend the loans to the farmers, and the agricultural input farms, which sell the products to the farmers. So how does this cover operate? The information is collected from the farmers based on the yields and other variables to support development of the design of the product. And this is normally collected over a given crop season to be able now to assess what are the yields, and then should it fall below, at least to be able to build up the model. Then there is a threshold which is set, and this will be the trigger for the payout. So if the yield falls below that, then the payout is triggered. And this information is based on historical experience, and that is why it is important to collect data from the farmers over a period of time to be able to assess. And the payout will depend on the structure of the policy, and premium payment depends on the risk, the policy structure, and the budget of the client. Currently, we have over 1 million farmers, and as you are aware, Kenya now has several counties. So it cuts across various counties which majorly specialize in crop farming. So what are some of the challenges that have been faced? There is the optimism bias, where farmers believe that they'll not be affected by these adverse climate changes. In Kenya, the weather patterns have been predictable. The rainfalls come at such a time. We receive the short rains, we receive the long rains. So even trying to sell to the farmers, this seems more remote until they are actually hit by the peril. Generally in Kenya, understanding of insurance is low. And then you now introduce this issue that there must be a trigger point for the payout to be made. So we still have low levels of understanding of insurance, and in particular, these specific products. At times there are disputes about the payout because it is based on a certain threshold. And the farmer would expect that if they don't get the return that maybe they had desired, then the insurance comes in to pay. But not knowing that there is a threshold that has been determined, and before that threshold is hit, then the payout is not triggered. The basis risk, which has been discussed at length this morning, and I don't need to deliver so much on it. There is the cost of investigation. And as you are aware, Kenya is a big country, and some places might be inaccessible. So this increases the transactional costs. We also have a challenge of getting accurate and reliable data from the farmers and the historical yield. And this one is very much relies on the data. So if the data is not available, then it becomes a challenge even to design the product. This issue introduces the moral hazard, where the farmers might start maybe engaging in risky business, or they don't take the necessary measures to minimize the losses because they expect someone will come in and compensate them should they not get what they expected. I've talked about the issue of the transactional costs, and yes, it has been discussed this morning. The amounts are small, so there is need for the company to break even. They require masses, which I think it's still a challenge to hit that. So what are some of the lessons that have been learned? That there is need for extensive sensitization on this product. Kenya, agriculture is the backbone of our country apart from tourism. So it is important that the farmers should be sensitized on this product, how it operates and the benefits, so as to enable them to manage the risks that arise from adverse weather, and especially with the climate changes that are taking place. Companies should come in and ensure that there is timely payouts to avoid that having a negative attitude or a negative perception towards insurance that they bought this and yet the company is not paying us when we really need it. And payments should be made on a periodical basis rather than a one-off payout at the end of the season. I cannot overemphasize on the issue of the data, that there is need to ensure that there is access to reliable and accurate data to be able to design and develop products that meet the needs of the farmers in a particular region. And I think with that, I come to the end of my presentation. Thank you. I'll ask my colleagues if there are any questions. they can chip in and we try to make any required clarifications. Thank you.
Thank you very much, Mary. Does anyone have a question for Mary on the presentation? Well, you have define if you have questions. I have like maybe a couple. Mary, as a supervisor authority, when you first, because Kenya has like several examples of index insurance as you presented before, but let's say the first time that you heard about index insurance, what were your concerns with that? And are those concerns or have those concerns evolved over time? So now there have been like many years of pilots, and have those concerns evolved? They have increased, they have been changed? And maybe the second question linked with that, what have you done in terms of regulation? Because we know that index insurance sometimes is not clearly defined in the traditional regulatory frameworks. So what steps have you adopted in order to unlock the opportunity to have like so many projects of index insurance in your country?
Thank you. I think at first when we got this, we were trying to see where does it fit in our law. And these providers, how will they be registered? Which category are they going to fit in? What requirements are we going to ask of them? Because we have a set of requirements for the traditional insurance service providers. So it was a bit of a challenge moving to and fro, but finally we decided to register them in a certain category to fit the law, so as to accommodate them, as we also study and try to understand how do we help promote the development of index insurance. And then after that is when the authority engaged a consultant who came up with a study and all that. And we decided to incorporate index insurance in our law. So we had first to have it incorporated as one of the categories of insurance that the authority supervises and regulates, which the law was passed, I think, in 2019. Currently, we are working on the regulations, which hopefully in the next 1 year or so, they'll have gone through the whole process and will now be ready to supervise providers of index-based insurance. I think as a country, we've learned a lot. And there is still a lot for us to learn, especially with the issue of technology, where who will be the underwriters behind these, how are they going to be linked and all that. So there is still, we still have a long way to go, and we still have a lot of learning to do and to customize our legal framework to accommodate the emerging opportunities that are arising for us. I think as a country, we have what we call the Bima Lab, where we are trying to encourage those people with ideas, innovative ideas, to come and we monitor and observe them in a controlled environment, and then see whether they'll now transit and become feasible and assist in the promotion of insurance. My colleagues in the house maybe can add on that. Thank you.
Yeah, thank you. Thank you so much, Andrea. Maybe if you can just allow me to project. Hello, can you hear me?
Yes, please go ahead. Just
Okay,
like, sorry, I'm just very conscious about the time. So Lucy, please go ahead and then we will jump to, yeah, thanks.
Okay, it's just I remember the last two questions you've asked.
Yeah, please go ahead.
So I think the first question you had was on IRA's concerns. So the first one were legal challenges. So here, maybe what we noticed sometimes we notice that the contract does not really fall under the legal definition of insurance. And then there's also the lack of insurable interest, because you see when it comes to index-linked insurance, it's it's very the insurable interest is normally diversified into like wider economic interest and not only the person. So, and therefore, as a result of this, there's usually aspects of uncertainty when it comes to payout, because you don't really know the relationship between the beneficiary, the affected, and the farmer. Because you can find like there is like a group of farmers who can just end up taking insurance covers, yet they're just employees of like the owner of the farm. So those are some of the concerns we had. The other concerns maybe were solvency concerns rather, because right now there's like a prescribed risk margin, which is based on, right now index link is categorized under the miscellaneous class under general insurance. And you see miscellaneous can have micro insurance, can have any other class that does not really fall under the other classes that have been prescribed. So having like one risk chart that does not really focus on the nature of the risk of this product will lead to maybe companies under reserving or having setting aside insufficient capital to really deal with the risks of this particular product. Then also you have to look at the balance between enhancing compliance and promoting innovation, because this is actually an ongoing innovation that is happening in this sector of this product. So we need to like really strike that balance. And maybe the final concern I'll talk about is under policy design, because should you permit cancellation rights, and what kind of adverse selection can be brought about when it comes to this cancellation rights. Then you also look at claim notification. Should the farmer maybe notify the particular insurer before a claim is processed? Those are some of like the concerns we had. If I can go to the maybe the perceptions now, or on index based, how these concerns are being handled right now. I think right now most farmers, and when they go and take out micro loans or loans, they're usually compelled to buy insurance. So this has actually helped to propel the index-linked, index-linked insurance or index-based insurance. Then also the use of pilot schemes has also really brought about certain forms of risk, because there are additional costs when it comes to regulating, because you're like not issuing a license for these companies to sell or these particular agencies to sell, but just to see how the product here is being receptive in the market. Then also poor design of some of these products has led to maybe lack of trust in the insurance sector, which is already being affected by that. Then also bundling of products, you'll find that maybe it's not only the farmer who's being covered, or not only focusing on weather, because you find that some products which are hybrid, where they can cover both index yield insurance and weather and livestock. So it's really hard to assess the success of this particular product. And then maybe just to focus on now the supervisory risks that we've focused on, or that are currently being encountered by IRA. I think we've talked about basis risk. I won't really focus on that. And then also I've also talked about the valuation methods and capital requirement, whereby we just have a prescribed risk chart that does not really reflect the individual risks. Then there is also need to provide other channels of distribution which are currently not licensed, something like NGOs or agricultural farms like seed sectors and all that, who are yet to be licensed, or we are yet to form like a licensing requirements for them. Then there's also lack of consumer protection, because this is a very complex product and farmers some of the farmers are illiterate, so they don't really understand how this particular product is going to affect them, or how the payout is going to happen. Then there's also no clear integration with the current government's agricultural policies. Those are some of the risks. Yeah, and maybe just to finalize, what are some of the approaches? I think Mary had already mentioned that we are trying to amend the Act. We are trying to now set up regulatory frameworks to just be able to support this particular kind of insurance, as well as also supporting the piloting processes despite the challenges that are being faced. I think other than the rest, Mary has already mentioned, so I'll just hand it over back to you. Thank you so much.
Thank you very much, Lucy. That's very helpful. And I think that this presentation really conveys and summarizes the main supervisory risks that we have been identifying in index insurance. I know that the time is quite limited, and if we can get back to the presentation, please. I know that we have our colleagues from Zimbabwe and Ghana who were going to present what I would suggest, because this topic actually is a topic that has connection with conduct of business. For instance, you mentioned quite a few conduct of business elements that are concerned for the IRA, and they are also concerns for Zimbabwe and Ghana, and this is how they took a certain approach. What I would suggest is that tomorrow, in the section on conduct of business, we're going to pick up the examples of Ghana and Zimbabwe. So I'm sorry for our colleagues, because I know that you prepare, but I think that it will be very good to frame those two presentations tomorrow morning. So if you don't mind, we will start with that tomorrow, and with that, we will have like a very nice flow for our session tomorrow. And maybe to finish this session, I just wanted to bring your attention on a couple of points that were mentioned by the IRA in Kenya, and I'm sure that in the case of Zimbabwe and Ghana, you have highlighted as well. So these issues that you have mentioned and you have identified actually have been identified by other supervisory authorities, and certainly there are issues in terms of the prudential side, but also on the conduct of business side. These risks change really depending on the evolution of the market of index insurance. And this is why I was asking the IRA about how those risks have been changing over time, because for a country where index insurance is just starting, maybe the concerns might be related about, I want to understand product design. How did you manage to come up with this model? Why did you set up this trigger? What data did they use? How are you going to communicate to the farmers? In a market where there are more and more interventions on index insurance, this might be still the problem, but then there will be other problems like solvency issues, reserves. How are you going to be able to cope with the financial impact when an event broadly happens in the country on index insurance, on a topic that probably you have been building capacities just for the 5 years? So this evolves very specifically for different countries. However, the supervisory risks relating with consumer protection becomes really on top of the minds of supervisory authorities. Stability of the market because of these potential elements that I mentioned. Maybe something that I have seen in the chat very quickly, and I think that tomorrow we can spend more time about that, because that really relates with consumer protection ultimately. Is like, is this index insurance is insurance or is a derivative? Is that, how do we define these? And I know that in some countries, actually, a position has been taken more on the side of derivatives, and others have been like really framing the idea of index more like as an insurance contract. So that's an important element. And also an important factor that is highlighted here is related with the principles of insurance. So this is connected with the fact, is this an insurance contract? So one key component that we have on non-life products is the fact that there is the indemnity principle that tell us that insurance is not a source of enrichment, and actually the compensation that the person receives should be aligned with the loss that is being suffered and the insurable interest that they have. So these are like elements that for supervisors are like, index insurance is challenging this. So just to finalize, I want to highlight that there are quite a few guidelines that could help you to solve these issues. So there are these papers that you're going to see in the chat. We're going to send the links. And very importantly, these experiences that are being shared. So we heard about Kenya. Tomorrow we're going to hear about Zimbabwe and Ghana. But what is very important maybe to highlight is that according to the index insurance paper of the IIS, an important message is that in terms of ensuring that consumers will be protected, it will be ideal that products that have been designed to tailor the needs at the micro level, so to promote access to insurance, must be part of the formal insurance sector, therefore need to be considered as insurance contracts, because that will provide all the framework of protection. several countries do not have a framework on derivatives, and consumers who participate in the market generally are very sophisticated and do not need certain levels of protection that are more required for these segments of the population. So that was really a decision taken more on the side of the consumer protection side. And these might change depending on who is the policy holder, because if it's the government who is the policy holder, maybe here the concern is not really in terms of consumer protection, and the financial stability risk is not substantial. So there are systems that could be offered outside of the formal insurance sector. So that's an important message. Another important message in terms of the indemnity component, the message is like indemnity. Like what really matters here is that there is an insurable interest from the person, from the entity who is like taking this product. So really is an issue of like validating that insurable interest, not necessarily quantifying the loss when this happens. So that's quite important. Some countries actually have considered that the indemnity principle is still present in index insurance through a kind of analogy of a presumption of loss, and therefore the indemnity principle is present. But other countries have decided to recognize that this is a completely different structure idea in insurance, so the indemnity principle doesn't need to be present. So they have designed these products as a non-indemnity product, but really that has really depend in the jurisdictions. Countries like Costa Rica, for instance, have like already a legal opinion saying that this is a non-indemnity product, whereas other countries like in Guatemala, for instance, the supervisory authority have like do an interpretation of the regulation in a way that it falls under an indemnity product. Then just to highlight something that it was mentioned by the IRA, the importance of pilots. So we won't learn about the complexities of index insurance, and we won't be able to understand the supervisory risks that are associated with index insurance if we don't test. So allowing innovation is key, not only for providers and consumers, but also for the supervisory authority. So I see that, for instance, South Africa was mentioned that you have sandboxes now for index insurance. So a test and learn approach is really advised. Now, I will finish with consumer protection because this is a topic of tomorrow, and I will pick on this tomorrow, and we will bring examples of Zimbabwe and Ghana. And these are like the concerns that generally are present, and like the messages of the IAS paper. So pay a lot of attention on product development. We're going to see that tomorrow. Pay a lot of attention in terms of the communication of these products to the consumers. I'm just going to show you that slide. So there is a lot of innovation on that tomorrow. We are going to see videos actually that have been like designed in order to communicate in a simple way these products, but very importantly in an accurate way without creating wrong expectations. Pay specific attention in the reliability of the index. You might not be sure about the reliability from the beginning. It will be very difficult to ensure that it's 100% from the beginning. But if you allow some room for testing and you check over a year, of a couple of years, how trustworthy is that index, that will be super helpful. So those are some of the elements that I wanted just to bring today. I really advise you to look at the IAS paper because it brings all these elements that were highlighted by the IRA, and that are very linked with our conversations on on inclusive insurance in general. So ultimately, I would like to finish this presentation by saying that index insurance is this kind of like intervention that brings a lot of innovation, and it has an important role in inclusive insurance. So all these lessons learned of this week are equally applicable for index insurance. It's not only about this session. So tomorrow we're going to pick up on this, and we're going to focus on conduct of business. And again, sorry for our friends of Zimbabwe and Ghana, but tomorrow we're going to get back to you on this. Well, thank you very much, and I give you the floor, Pascal.